since I was a kid, I've had a terrible rote memory. And I didn't like following instructions. I was no good at following instruction. But I loved to figure out how things worked for myself. When I was 12, I hated school, but I fell in love with trading the markets. I caddied at the time, earned about $5 a bag, and I took my caddying money and I put it in the stock market. And that was just because the stock market was hot at the time. And the first company I bought was a company by the name of Northeast Airlines. Northeast Airlines was the only company I heard of that was selling for less than $5 a share. And I figured I could buy more shares, and if it went up, I'd make more money. So that was a dumb strategy, right?
Yes, that was a dumb strategy, but remember, you gotta take your chances. You have to make your moves if you want to stand firmly against the growing inflation. Hello, and welcome back to Conglomerge, where we bring you the best content around financial freedom. In today's video, we'll see how to prepare your finances for the upcoming continued high inflation or possible deflation in our economy.
I tripled my money because I got lucky. The company was about to go bankrupt, but some other company acquired it, and I tripled my money. And I was hooked. And I thought, this game is easy.
He was lucky, but not always everyone gets an easy start. And even after an easy start, you might find yourself in a puddle. But the basic thing you can do to improve is to increase your income and start with low-risk investments.
In order to be an entrepreneur, a successful entrepreneur, one has to bet against the consensus and be right. I had to be an entrepreneur and an investor. And what goes along with that is making a lot of painful mistakes. I began to think of them as puzzles, that if I could solve the puzzle, do differently in the future so I wouldn't make that painful mistake. And the gems were principles that I would then write down so I would remember them that would help me in the future. I wanted to find the smartest people who would disagree with me to try to understand their perspective or to have them stress test my perspective. Imagine if you knew what they were really thinking. And imagine if you knew what they were really like. And imagine if they knew what you were really thinking and what you were really like.
That's what you need to do. Write down your mistakes, minimize them, stop making same mistakes again and again. But don't stop investing. Just adjust how you do it.
And people want to invest, like in the stock market, they want to invest in the companies doing well, not the companies doing badly. Yeah. So if they say, this is a waste, why should I invest it? It's hopeless. You have to take away that hopeless and say, we can make this a lot better.
Keep investing at every dip, and in this inflation times or even during deflation, you'll get more than one opportunity. But don't try to predict the bottom.
Excuse me. There's a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100, people said, here's this great company, great record. If it ever gets below 100, just buy every share, and it did get below 100. A lot of people bought on that basis saying, look, it's gone from 135 to 100. It's now 95, what a buy. Within a year, it was 18. And this is a company with no debt. This is a company, it was just so overpriced, it went down. If you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say it's 3, how much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7.
This perfectly shows why you shouldn't invest all your money in one stock. You shouldn't even go for one type of investment. Diversify with time and learn about more types of investments. Remember, there aren't any recession-proof stocks. The best you can do is diversify by sectors.
Investing is more than just, the way to really understand investing is to understand a business. And one of the most important skills you need as an investor is distinguishing between a great business, a good business, a fair business, and a bad business. And one way to get a sense of the quality of a business is go to work for one. In terms of the future of fundamental investing, I don't think everyone can be a passive investor, and I don't think everyone can be a quantitative trader. And I think there will be always for fundamental value investing, because fundamentally stocks are driven, and business value is driven by business fundamentals, not supply and demand for securities in the short term, not the weather on certain days, and these various signals that are used by quantitative traders. I'm not saying there's anything wrong with it, but I don't think that even quantitative trading works unless there are a lot of people making fundamental investment decisions.
And most people think, give me the best investment and let me put all my money in what I think is the best investment. Wrong. Find your best 10 uncorrelated investments and put your money in that, and you're going to do a lot better. And this just gives you an example.
Fundamental investing is the best decision you can make where you can minimize your mistakes. Find a great business and stay invested in it for long enough.